2023 was an exceptional year for Carvana. It was our best year from a financial perspective by a long way. Full year GPU was nearly $1,000 better than our previous best in 2021. Our full year adjusted EBITDA per unit was over $900 higher than our previous best, and we have clear visibility to further improvements, as you can see in our outlook. Today, Carvana sits in the strongest position we have ever been in for 5 reasons. Number 1, our customers love the experiences we deliver, and as we execute, these experiences are getting even better. Number 2, the financial power of our business model is becoming clearer every quarter and is highly differentiated. Number 3, our infrastructure is simply unmatched. We have built a vertically integrated machine with 6,500 acres of land and over 500,000 parking spots that scalably and cost-effectively gets cars from one customer to another more efficiently than any other machine that serves the same purpose. Number 4, competitively, we have never had more separation. As we continue to execute, that gap is getting bigger. And number 5, we compete in a $1 trillion market, and we currently have approximately 1% market share. The potential is obvious.
We set company records for fourth quarter and full year total GPU and adjusted EBITDA, completing a year in which we improved adjusted EBITDA by nearly $1.4 billion and positioning us well for further adjusted EBITDA growth in 2024. Based on our Q1 outlook, we expect to generate significantly above $100 million of adjusted EBITDA, equating to significantly above $1,200 per retail unit sold. Despite declining used vehicle prices, industry volumes that remain below pre-pandemic levels, and sizable costs of carrying capacity for future growth. Based on industry data sources, we gained market share on a sequential basis in Q4. We have a unique and powerful infrastructure for significantly and efficiently scaling retail unit volume, with excess capacity in our existing footprint to support multiples of profitable growth. While the macroeconomic and industry environment continues to be uncertain, looking toward the first quarter of 2024, we expect the following as long as the environment remains stable. We expect retail units sold slightly up on a year-over-year basis, and we expect adjusted EBITDA significantly above $100 million.
Car prices themselves are probably still on the order of give or take 10% higher than other goods in the economy. So I think that suggests on a price level there's potentially room for that to continue to moderate over time. I think if you look at monthly payments, which compound that and the moves in interest rates, monthly payments are probably on the order of more like 20% higher relative to other goods than they were pre-pandemic. So I think that also kind of points a little bit in the direction of room for moderation. I think generally speaking, for us, probably lower is better. I'm not sure that there's a level that we're trying to get to. I think it makes cars more affordable for customers. It pulls more people back into the market. Today, we're moving cars inbound to our inspection centers, approximately 20% fewer miles than we were a year ago. Outbound, we're moving cars 30% fewer miles. That's because we've got more of these facilities and we've integrated, intelligently into our scheduling systems to make better choices there. In market ops, we're now, pairing almost 50% of activities, which means, when we deliver a car to a customer, on the way back, we are picking up another car to get more efficient. I think, that's up 75% year over year as we put time and effort into building those systems to make them smarter and building the scheduling systems to make it more likely that we see overlap. That gets better as we get more density in the network, and there's still a lot of room to improve there. The question is not where we're going. We have every intention of selling millions of cars. We've never been better positioned for it, and that is absolutely what we intend to do. But now we got to figure out how quickly we can do it and how efficient we can be along the way.
People for a long time, didn't believe, just to say it candidly, that a vertically integrated e-commerce online sales model, could work. And now we're sitting here, in the first quarter of 2024, and, I think we're, very confidently saying we expect to drive significantly more than $100 million of adjusted EBITDA, or significantly more than $1,200 per unit of adjusted EBITDA in the first quarter. And, we're also doing that in an environment where rates are at multi-decade highs. We're doing it in an environment where the used vehicle industry as a whole is still, noticeably down relative to pre-pandemic levels. Moreover, we're doing it while also carrying significant costs of excess capacity that, we view as a huge benefit for us as we look forward, because we're generating a lot of adjusted EBITDA now at a volume that is far below, what our capacity can support from an overhead cost and fixed infrastructure perspective. And so I just think when you start layering all of those things on top of each other, it gets us, very excited about where the model can go. I think it resoundingly answers the questions about whether or not this is a long-term profitable business model, whether or not this is a long-term sustainable business model. That's one of the things, as I mentioned, that I think we're feeling really good about, and why I called out that one data point in my prepared remarks.